Hey everybody, Mark Panazon here, mortgage broker with Mortgage Connection. Hope you're having a great day. I wanted to put up a video for you guys with some technical analysis on some interesting trends that are happening that I think we can all kind of get excited about. So without further ado, I want to show you just some movement in the 5-year bond yield. And as a reminder, fixed mortgage interest rates follow the bond yield. So this is a pretty important metric, and if we can start to see the bond yield go down, as you can kind of see it is, then fixed rates should follow. So I just want to show a couple interesting things here for all you sort of geeks out there that are interested in the technical part of what's happening behind the scenes. So first off, this is the long history of the 5-year bond yield. So if you can kind of go way back through COVID here, I'm going to show you the big drop to kind of give you perspective, and then we'll talk about what's happening. So obviously in 2020, you can see that the 5-year bond yield dropped, and this period here from about March 20 to February 21, so about a year, this was the golden opportunity to secure interest rates. This is where all the 1 to 2% interest rates were selling. This was the time to buy a home and or renew your mortgage or refinance. So we were around that 1.6% on the bond yield. You can kind of see right there, 1.6 to 1.8%. That doesn't mean interest rates were 1.7%, but the bond was 1.7, and interest rates were roughly 2% higher, or even 1.5% higher. So they were about 3 to 3.5%. So we had this big drop. Interest rates were around 1.5%. And then we've just started climbing ever since, right? And then so we've been on this path of interest rates just blowing up as inflation has peaked. So that's kind of been the long journey. Now I want to zoom in a little bit to the recent activity. So I'm going to jump to the hourly chart here. And I just want to show you this trend here. So we've kind of seemed to hit a bit of a top here early October. So about a month ago, we kind of seemed to rise up, peak, and then it's kind of been making its way down. And I want to layer over what we call the golden and death cross. So this is just a pretty common metric that traders use to identify patterns and trends. They use them usually with stocks, but I think you can use them with the yield as well. So what we're looking at here is these red crosses and these green crosses. The red crosses indicates when the 50-day moving average crosses below the 200-day moving average. If that happens, usually there's a big sell in the market. So what happened here is you can obviously see that the bond was going way down, triggered the cross, which obviously triggered further drops in there. So if this was a stock, you'd want to try and sell around that time. For interest rates, you know that rates would be coming down, which is a good thing. Conversely, the green cross here, which is called a golden cross, it's green on my chart because I just think it's easier to read green and red, stop and go. But the green crossed over here when we've had this momentum of interest rates increasing based on inflation data. So sort of the first week of October, you can kind of see that they've been rising. So we had this flag, but then they quickly reversed again. So what's interesting about this is we're currently at the death cross here, which is good for interest rates because the bond yields lead fixed rates. And we've seen this trend now since basically about 10 days ago continue to come down. So we should see fixed interest rates continue to trend downward. They've been sort of slipping a little bit, but there's been some big moves here the last couple of days downward. So I would be shocked if we don't get any new fixed rate specials, maybe 10 to 20 basis points lower than they are today. So that's the first interesting thing, is just noticing this recent trend over the last 10 days or so coming down and really kind of starting back here from early October. So over the course of the last month, rates are trending down. That's a good thing. Next, I want to just layer in the variable rates as well. And I want to layer in inflation to show you the bigger picture of what's happening. So if we zoom out here and go to just going to show you what this looks like here. Okay, so the red line is going to be the Canada overnight rate. So this sort of controls variable rates. You can think of it as the variable rate. You can think of the black line, the bond yield, as the fixed rates. And the yellow line is inflation. So inflation controls everything. You can see back here, if we zoom out to 2020, COVID happened. We were deflationary at that point. Bank of Canada dropped rates, bond yields were dropped, and we were in this really low period of good opportunity to get financing. Then inflation started to ramp up here, and you can see it got really out of control and peaked last summer around June at around 8%. So that was bad news. A lot of criticism came down from the Bank of Canada because they didn't start increasing the interest rates until around March, and inflation was ticking up in May. So they were slow to the game, which allowed inflation to kind of get a little bit out of control, whereas if they nipped it in the bud a bit sooner, perhaps inflation would have been in a little bit more control. Remember, the only tool the Bank of Canada has to control inflation is the Bank of Canada overnight rate. So that's the main metric they use. Now, inflation peaked, the bank started increasing interest rates. That's where if you had a variable rate mortgage, your payments or your amortization were really starting to skyrocket or extend. So, but then we had hit this peak, and then we had, because of the rate increases, that's helped lower inflation. And so if you kind of zoom into this last period here, you can kind of see the bond yields sort of figuring themselves out, sort of peaking right around here, and then sort of chopping around during this time as inflation was coming down. So they weren't increasing any further because the data was coming in, inflation was coming down. So we were kind of hitting a bit of a top here. And then we had this last tick up of inflation where it went from 2.8% to it jumped up, I think 20 basis points or something like that. But it jumped up here, and then, of course, the bonds started to increase again, and then the Bank of Canada got involved again and had one rate increase here, another rate increase here, and now we've been flat since July. So there's been no rate increases from the Bank of Canada since July, and now we've had this most recent dip again. So you can kind of see what's happening here. Bigger picture zooming in, big inflation peak, clearly a top here, working its way down, and even though we had a bit of a bump here, it's now trending back down again. The Bank of Canada needs or wants this inflation number to be below this 2% line. So we're nearly there. We're at 3.8%. We're nearly there. The target is typically between 1 and 3. They want to, I bet you they'd settle for 2.5 or 2.3 or something like that. And they're not going to drop this variable interest rate until inflation gets down. Now remember, it's the main tool that they use to control rates. So what's good? Well, inflation's peaked. It's coming down. It's making its way down, even though we're up on the last report. It's down again. Bond yields are starting to tip over, and the Bank of Canada hasn't made a rate increase for about 3 or 4 months. So this is all good news. If this trend continues, which it should, then you'll see fixed rates come down in the short term, and then probably next year you're going to start seeing that variable rate come down as well. So this is all really great news if you're in an existing mortgage on a variable, or if you're coming up for renewal in the next 6 to 12 months, or if you're looking to buy a home in the next 6 to 12 months. Good rates are on the way. So we should be feeling really great about that. Okay, that's all I got for you on this video. Hopefully that's been super informative and educational. If you have any questions, feel free to leave them in the comments. Otherwise, you can reach out anytime with your mortgage questions. Be happy to help. Have a great day. We'll talk to you later.